How can commodities protect purchasing power during inflation? Imagine a world where the prices of everyday goods like food, fuel, and metals are climbing higher each year. When inflation hits, your money buys less and less. But what if there was a way to help your investments keep pace with rising costs? That's where commodities come into play. They are physical goods such as oil, natural gas, gold, and agricultural products. When inflation increases, the prices of these commodities often go up too. This means their value can rise at the same time as inflation, helping to preserve what your money can buy. Commodities are directly linked to the costs of producing goods and services. When inflation pressures build, energy prices like oil and natural gas tend to increase because of supply constraints or higher demand. These rising costs push the prices of commodities higher, which can offset the decline in the purchasing power of cash or fixed-income investments. For example, if inflation causes food prices to rise, agricultural commodities like wheat and corn often see their prices increase as well. Historical data shows that during periods of inflation, commodities tend to deliver positive real returns. This means that even after adjusting for inflation, commodities can still grow in value. When inflation rises by 1 percentage point, commodities often see a notable increase in their real returns, while stocks and bonds may struggle or decline in value. This is because rising commodity prices can signal economic growth or supply shocks, both of which tend to push commodity prices higher. Commodities also have a high inflation beta, which measures how sensitive their returns are to changes in inflation. Over time, commodities have shown an inflation beta of around 6 to 10, meaning a small investment in commodities can provide significant protection against inflation. This makes them a smart addition to a diversified portfolio, especially when inflation is expected to rise. However, it is important to remember that commodities do not always outperform during every inflationary period. When inflation is very low or stable, commodity returns might be negative. Also, not all commodities respond the same way. Broad exposure to a variety of commodities like metals, energy, and agricultural products tends to be more reliable than investing in just one, such as gold. Gold is often seen as a safe haven, but it does not always keep pace with inflation during high inflation episodes. Many investors include a mix of commodities in their portfolios to hedge against inflation. This diversification helps capture price increases across different sectors, reducing reliance on any single commodity. Combining commodities with traditional assets like stocks and bonds can help protect your wealth when inflation rises. In short, commodities help protect purchasing power during inflation because their prices tend to increase along with inflation. They can deliver real gains when inflation climbs and act as a buffer against the erosion of your money's value. By including commodities in your investment plan, you can better shield your savings from inflation's impact and maintain your buying power over time.